Welcome to Sophisticated Saving, where we unravel the intricacies of investing and guide you toward financial mastery. Today, we'll explore 12 common mistakes that nearly every investor makes, according to the legendary Warren Buffett. Stick around, as these insights could be game changers for your investment journey. Timing the market. One of the most alluring traps for investors is trying to time the market. Warren Buffett, along with his partner, Charlie Munger, famously avoids this pitfall. They focus on analyzing individual businesses rather than predicting market movements. The reason predicting the market is so tempting is that external factors like economic downturns, inflation, or geopolitical events can drastically affect stock prices, making it seem like timing could be a viable strategy. However, Buffett believes that these variables are unknowable. Instead, he emphasizes identifying superior companies at fair prices. Imagine the stock market as an ocean. While the tides may rise and fall unpredictably, the quality of the ship remains key to surviving the storms. So, focus on the vessel, not the sea. Getting attached to your purchasing price. A common mistake among investors is getting emotionally attached to the price at which they purchased a stock. This can cloud judgment and lead to poor decision making. For instance, if you bought a stock at $100 and it drops to $50, you might feel compelled to hold on to it until it bounces back. Conversely, if it rises, you might sell too early to lock in profits. Buffett teaches us that the only thing that matters is the company's future performance, not your buying price. Consider this analogy. If you bought a house years ago for $200,000 and today it's worth $400,000, would you sell it just because you've made a profit? Or would you continue living in it if it meets your needs? Stocks should be treated the same way. Their value lies in their future potential, not in your past transaction. Focus on where the business is headed, not where it's been. Aggressive growth projections. Many companies project high growth rates to justify their valuations. Buffett warns against falling for these optimistic projections, as very few large companies can sustain such high growth. He prefers businesses that can grow steadily without needing excessive capital. While high growth can be enticing, it's crucial to remember that sustainable growth, even if slower, often leads to better long-term results. Imagine investing in a young tree. You can choose one that promises to grow rapidly but might be vulnerable to diseases and storms, or one that grows slowly but steadily, becoming a strong, resilient tree over time. In investing, the latter is preferable. Sustainable, manageable growth is more reliable and less risky than betting on a rapid expansion that may falter. Using a lot of leverage. Leverage involves borrowing money to invest, amplifying both potential gains and losses. Buffett strongly advises against it, likening it to playing Russian roulette with your finances. Even if you're right about a stock, leverage can force you to sell prematurely if the market moves against you temporarily. This can result in significant losses. Think of leverage like a high-stakes game. You might be a skilled player, but if the odds are stacked against you and you're forced to cash out at the wrong time, your skill won't save you. Leverage can turn a promising hand into a disastrous loss. It's safer and smarter to invest money you can afford to leave in the market for the long haul. Missing the forest for the trees. Buffett stresses the importance of not getting bogged down in minor details. When evaluating a business, instead focus on the bigger picture, the company's future economic prospects, the quality of its management, and whether the price is right, spending too much time on small details can lead to analysis paralysis and missed opportunities. Imagine trying to solve a jigsaw puzzle by examining each piece individually without considering the image on the box. You'd miss how the pieces fit together to form the complete picture. Similarly, in investing, while details matter, they should not overshadow the overall potential and health of a business. Focus on the big picture to make informed decisions. Jumping over 7-foot bars. Buffett and Munger prefer simple, understandable businesses. They avoid complicated ventures that require extensive analysis and prediction. In investing, attempting to solve overly complex problems can lead to mistakes. It's often better to stick with businesses that are easy to comprehend and evaluate. Think of it like this. Would you rather build a simple, sturdy bridge over a narrow stream, or attempt a complex suspension bridge over a wide chasm? The former is easier, less risky, and more likely to succeed. Similarly, investing in straightforward, understandable businesses minimizes risk and enhances your chances of success. Shrinking your universe of opportunities. Buffett believes in keeping an open mind and not limiting investment opportunities to a specific sector or type of company. While it's essential to stay within your circle of competence, being too narrow-minded can result in missed opportunities. The best investments often come from unexpected places. Imagine fishing in the same spot every day. Eventually, the fish will move, and you'll be left with an empty line. Expanding your horizons and exploring new fishing spots increases your chances of a good catch. Similarly, broadening your investment scope can uncover hidden gems that others might overlook. Staying active all the time. Buffett advocates for patience in investing. Unlike other professions where constant activity leads to success, in investing, sometimes doing nothing is the best strategy. It's crucial to wait for the right opportunities rather than feeling pressured to make frequent trades. Picture a lion hunting the savannah. It doesn't chase every animal it sees. Instead, it waits for the perfect moment to strike, ensuring a successful hunt. In investing, patience and timing are key. Waiting for the right opportunity can yield better results than constant, impulsive trading. While diversification is a common strategy to mitigate risk, over-diversifying can dilute potential returns. Buffett suggests that owning a few well-researched, high-quality stocks is more effective than spreading investments too thin. Concentrating on your best ideas often leads to better outcomes. Think of your investments as a garden. Planting a few well-tended, robust plants will likely yield a more bountiful harvest than scattering seeds everywhere and hoping for the best. Focus on nurturing your top investments to maximize growth and returns. Investors often fall into the trap of seeking information that supports their existing beliefs while ignoring contrary evidence. This can lead to poor investment decisions. Buffett advises staying rational and open to all information, even if it challenges your views. Imagine wearing rose-colored glasses that make everything appear positive. While this might seem pleasant, it obscures potential dangers and pitfalls. Removing those glasses allows you to see reality clearly and make informed, balanced decisions. In investing, embracing all information, positive and negative, leads to better outcomes. It's natural to want to follow popular trends, but in investing, this can be detrimental. Buffett and Munger avoid herd mentality, focusing instead on independent analysis. Just because everyone else is buying a stock doesn't mean it's a wise investment. Think of a crowded amusement park ride. Just because everyone is lining up doesn't mean it's the best ride for you. Sometimes, the less popular attractions offer a better experience. Similarly, independent thinking and investing can lead to discovering undervalued opportunities that crowd overlooks. Buffett considers the biggest mistakes to be the opportunities missed due to inaction. Recognizing a great opportunity with your circle of competence and not acting on it can be more costly than any error of commission. Picture standing at the edge of a beautiful, inviting lake on a hot day, but hesitating to jump in. Missing out on the refreshing swim is a regret you'll carry, especially when you know how enjoyable it would have been. In investing, hesitation can lead to missed opportunities and significant regrets. These are the 12 deadly sins of investing, according to Warren Buffett. Avoid these pitfalls, and you'll be well on your way to a more successful investing journey. If you found this video helpful, please like it and subscribe to Sophisticated Saving for more insightful content. Your support helps us create more videos to guide you toward financial freedom.